All right. Good evening, everybody. Thank you all for joining us. Really excited to share this information tonight. As you can see, the topic for the evening is Social Security planning for women. And we actually got the question, why is this, something that we have to do for women? So I want to hop right into, the reason for that. The reality of it is here in the United States, women unfortunately have lower lifetime earnings. What does that mean? It means that their Social Security benefit oftentimes is going to be less. It also means that their pensions, if they're fortunate enough to work at an employer where they would have a pension, their pension is probably going to be less than their male counterparts. And as we mentioned with regard to life expectancy, women also tend to live longer lives than men. And so those three things kind of combined mean that, when you look at retirement planning for women specifically, there are a lot more pressures that come into place on their IRAs, 401ks, things along those lines with regard to their personal savings than possibly it would for, again, their male counterparts. Also, just personally, I've seen this within my own family. My mom's earnings record compared to my dad's earnings record for Social Security, very, very different. My dad's earnings record was much, much higher. They owned a family business, and all of the income always went to my dad's earnings record. So my mom's Social Security benefit, was much lower. And a lot of the time, she was, kind of spent, at home, whether it was taking care of me, my brothers and sisters. But she also worked very, very hard, not just at the house, but also outside of the house as well. And when it came time to looking at drawing Social Security, it really meant that these later earnings years made a huge, huge impact on her benefit, right? And there's a big value in working just a few years longer. We'll talk a little bit more about how your Social Security benefit is calculated, but when you think about when am I going to retire, when should I retire, when can I retire, is the answer tomorrow? Maybe it is. I don't know your specific situation. Hopefully it is for everybody out there. But, the thing to think about also is just the benefit to working a little bit longer. It gives you the ability to pay down maybe any lingering debts that might be out there. Also can give you the benefit of adding more to retirement savings. $1 saved today can be $2 down the road to help you in the future. It also reduces your retirement drawdown period. If your life expectancy is the same, but you're working 1 year longer, that's one less year that you're pulling from your assets. So there's a higher likelihood that you would not, run out of your investments or run out of money. But the topic of the evening, of course, is Social Security, and that can raise your Social Security benefit. Social Security is based off of your 35 highest years of earnings. Generally speaking, most folks that we work with are earning more in their later years than in their early years. So say if you've worked 36 years, then your most recent year is going to knock off your first year or whatever your lowest year of earnings. So we'll get a little bit more into that. Okay, let's talk a little bit about the value of Social Security. One of the biggest pieces of value of Social Security is that it provides income that you can't outlive. All right. And I know we hear a lot in the news, Social Security is going bankrupt. It's not going to be there. We are very, very confident that Social Security is going to be there in one, shape, form, or another. Does there need to be some reform to it, some adjustments? Yes, absolutely. But, we really feel that that's going to more so impact future generations rather than, folks who are closer to drawing Social Security or potentially even already drawing. So when you think about Social Security, I want you to feel confident in the fact that this is income that you cannot outlive. All right. And if you think about that, if you have a $2,000 monthly benefit, just a good round number, easy number to look at, $2,000 a month for 10 years is $276,000. You might say, Emmett, I did some quick math, 2,000 a month, that's 24,000 a year. For 10 years, that's $240,000. What are you talking about? Well, if you look at the bottom there, you can see that assumes a 2% cost of living adjustment. As we'll see on the next slide, your Social Security check generally is going to increase as time goes on. And the average over the past 20 years is a 2% increase per year. Okay. Now, there can be some years where it's higher, like from 2021 to 2022 is much higher than that, but also some years where it's lower as well. So when you look over 30 years of drawing Social Security at $2,000 a month, that could mean over $1 million in benefits that you would receive, or in income that you would receive from Social Security. If I told you that you could have $1 million in your Social Security account, what would you have thought before looking at that? But that's the value that there is out there. Next thing, like I said, Social Security offers annual inflation adjustments. So again, looking at that $2,000 per month over 10 years, that monthly check isn't going to be $2,000 per month anymore. If it's a 2% cost of living adjustment, which that's not a guaranteed set number, it's tied to inflation. 10 years down the road, that would be $2,438 per month. In 20 years, you're looking at $2,972. And in 30 years, you can see that number has climbed all the way up to about $3,600 per month, all from the same initial $2,000 a month benefit. So some things that you're going to want to consider and think about, especially as we go through this information here this evening. First, do you qualify for benefits on your own work record? What I mean by that is, have you worked for at least 10 years in a job that was covered under Social Security? Meaning there's taxes taken out of your paycheck, or if you're self-employed, you pay self-employment taxes where you're paying into Social Security. So have you done that for at least 10 years? Next question, are you currently married? If so, has your husband or has your spouse started to receive their Social Security benefit? Have there been any prior marriages? Anything that has been a marriage that maybe has ended in death or divorce? If it's a marriage that ended in divorce, did that marriage last at least 10 years? Is your ex-husband still living? Is he over age 62? Is he kind of in the Social Security claiming window? We'll get into some of the reasons why these things are important, but just, think about these, think about your situation, and that will help you to digest some of this information that we'll go through here today as well. Depending on what your answers are, there's 4 different types of benefits that you may be eligible for. First of which is just your normal retirement benefit, where you claim on your own work record. Second could be a spousal benefit. This is where you can claim off of your current spouse. Third is a divorced spouse benefit. Pretty similar, but it just means if there was a marriage that lasted over 10 years and you're able to claim off of your ex-spouse. And then lastly, being a survivor benefit. And that works for marriages that, either ended in divorce or did not end in divorce. The key thing is it's important to kind of look at all of these different things, any of these that you may be eligible for, and coordinate them together, because you can kind of time them off of each other in some ways sometimes. And that's something that Marcus and I can kind of go through, and Marcus is going to cover a couple of different scenarios on how that can happen in the back end of things as well. A few definitions here. First one, full retirement age. You might hear me say FRA. I'll try not to. I know it's kind of a weird word. I kind of think of it a little bit like jargon. I try to stay away from that. But full retirement age, take a look. What year were you born in? And then look over to the right. That's what your full retirement age is. Your full retirement age is the age at which you can claim an unreduced benefit from Social Security. Anything you do before your full retirement age is going to be reduced, right? I think we have a poll question that's going to dig a little bit more into that, right? We're doing that now, Marcus?
Yep. So if we could take a quick time out, here's another question for you to challenge your thoughts. Question is asking, how much will your monthly Social Security benefit check be reduced by if you start withdrawing at age 62 instead of waiting until your full retirement age? So again, the question is, what percentage of a reduction is that in your monthly benefit, annual benefit, if you take your benefit at 62 or any point sooner than your full retirement age? All right, getting a lot of different responses here, so it's going to allow 30 more seconds. All right, 10. All right, so we're just going to bring that to a close and share the results. So, as you can see, a few respondents answered 5 to 10%, 10 to 15%, which I will say from a technicality standpoint isn't a completely wrong answer, because the closer you get to that full retirement age, that percentage reduction does decrease. However, the question is asking at 62 versus your full age, the percentage decrease is actually 25% to 30. So if your full retirement age were 66 and you take it at 62, you're looking at a 25% decrease. If your age is 67, then your percentage decrease is roughly about 30%. Any of those odd months in between would be the odd percentages between that range as well.
Awesome. So that's important to, look at and consider as you, look at this next slide here, which talks about your primary insurance amount, or PIA. Your PIA is the amount of Social Security benefit that you would receive at that full retirement age. So you can see here, this is what the statements used to look like. They were kind of redesigned, a couple of new colors. But another thing, you might notice you never got these, or you haven't gotten these statements in the mail recently. That's one of the ways that Social Security cut down on the budget. They stopped mailing these statements out. I guess they had to save 50 cents per person. So you don't get them automatically mailed out to you every single year like you did before. Now you need to go to the website, create a login, and we'll talk about that. But your PIA is the amount that you would get at your full retirement age. So if your full retirement age is 66, you can see here it talks about $2,029 per month. Now, the key thing to consider as well is that's not the age that you have to draw, okay? You can defer, and if you look at the number just below that, what you'll see is that you can defer to age 70, and you would get $2,678 per month in this scenario, right? So the amount is going to increase every year that's deferred from 66 to 70. There's an automatic built-in 8% increase year over year. Now, two other things that can impact that as well. One, if you're still working, that's going to increase that because your earnings record is going to be improved. Two is if there are inflation adjustments, you would still get those inflation adjustments as well. The other side is, some people retire earlier than 66 or earlier than 70. And if you look here at retiring at age 62 and starting Social Security right at that point, that's the earliest that you can draw under your normal claiming scenarios. Disability scenarios is not impacted by the same age requirements. So starting at age 62 in this scenario, you can see that benefit goes to $1,530 per month. So good thing is you've got income coming in, 4 years earlier or 8 years earlier than if you delay to 66 or 70. Not so good thing is obviously that's going to be a much, much lower Social Security check, and it's going to stay lower for your entire life after that. So it's very, difficult to change that after you've started that claiming process. So one important thing that I would say, before you file, before you claim, make sure you've run all the numbers and see, okay, yes, this is exactly when I should claim, and this is why. And again, if you need help doing that, if you need help looking at your personal situations and scenarios, that's exactly what Marcus and I are here for as well. We can, run a couple of calculators for you. Here's where you can go to get your Social Security benefit estimate. Go to socialsecurity.gov/myaccount. All right. And if you have never gone to that website before, if you take nothing else from tonight's session, go to that website and create a login. If you do it, that means that nobody else out there can. We're hearing a lot in the news right now about hacks, cybersecurity, everything that's going on out there. So please go out there, create your account. One, you can get your information, you can get your statement that they're not mailing, you can get your benefit, everything along those lines. But two, it protects yourself from potentially somebody else out there going and doing it for you, so to speak, and then potentially harming you in many different ways. So go get your Social Security statement. Second, you can get a retirement estimator right on there, and they've got some calculators on the website that you can use as well. A few points to remember about when to apply for Social Security. One, like I said, if you apply early, your benefit is going to start lower, it's going to stay lower for life. And that lower benefit is actually going to be magnified by the cost of living adjustment. When we talk about a 2% increase, if you have 2% of $2,000 versus 2% of $1,500, that dollar amount difference, you're going to get a bigger raise on a bigger benefit. So the longer that you live, it benefits you even more to delay your benefits. Your decision on when you claim also impacts your survivor benefits as well. And if you're currently married, or if you have the type of relationship with your ex-spouse where you could say, hey, don't draw your benefit, delay your benefit, because if I outlive you, that means that I can get a higher check. That's something that you can always bring up with them as well. All right, so let's talk about these types of benefits. First, spousal benefit. A spousal benefit is where you can get 50% of your husband's primary insurance amount, or PIA. That 50% number, that's if you apply at your full retirement age. Okay, so if you apply before, it's going to be reduced. There's no delayed credits on spousal benefits, but it's important to note if you apply earlier, it will be less. Important thing to note here is that your husband must have filed for his benefit for you to start your spousal benefit. So if we look at a quick example, say Jack and Jill are married, Jack's PIA is $2,400. Jack files for his benefit. Jill can get a spousal benefit of an additional $1,200 per month. Now, together as a household, there's $3,600 coming in. So that one's fairly straightforward. Second one is a divorced spouse benefit. So if there are anybody who's been divorced, make sure to pay attention to this. First factor that comes into play is that the marriage must have lasted for at least 10 years. Next, you have to be currently unmarried. If you've gotten remarried, or if you are remarried right now, then this would not apply. Your ex-husband has to be at least 62 years old. And if the divorce was more than 2 years ago, he doesn't have to have filed for his own benefit like it would have been in the spousal benefit. So it doesn't matter if he's filed or not if your divorce was more than 2 years ago. And the way that the divorce spouse benefit works is the exact same as that spousal benefit, where you would get 50% if you're applying at your full retirement age. Next one is survivor benefits. Survivor benefits actually allow you to start a little bit earlier. The earliest that you can start a survivor benefit is age 60, which is a reduced amount. And again, as long as your husband died before that point. If your husband dies after you turn 60, you can start your survivor benefit immediately, but it's going to be reduced as long as you're under your full retirement age. One key factor here also with survivor benefits is that you must have been married at least 9 months, unless the death was due to an accident. And the way that a survivor benefit works is it basically means that you're able to get the same amount as what your spouse would have gotten. So it's not a 50% reduction like it is with the spousal and divorced spouse benefits. And then there's also the combination of the second and third ones where it's a divorced spouse survivor benefit. Same as survivor benefits, only difference here is that it's for divorced spouses. Again, have to make sure that the marriage lasted at least 10 years. And again, have to make sure that you're currently unmarried. Or in this scenario, your remarriage took place after age 60. So when you look here, you can see Sam and Sue were married from 1970 to 1985. Sam died in 1995. Sue has not remarried. As soon as Sue turned 60, she would become eligible for reduced divorced spouse survivor benefit. So she could start to claim that. And then assuming Sue still worked and still had her own benefit, she could let that sit and grow potentially as well and allow her benefit to be deferred so that it could be more for her later. All right, so one key thing, if you think that you might outlive your spouse or your ex-spouse, again, if you can, try and encourage them to delay the start of their benefit as long as possible. Again, if we go back to my family situation, when we looked at my dad and my mom, they're both claiming Social Security at this point. My mom and I tried our hardest to get my dad to delay his benefit as long as we can, so that in the event that he passes away first, that my mom would get, a bigger survivor benefit. Same goes the other way as well, because if my mom passes away before my dad, well, her check still stops. So either way, my dad's benefit is going to be the one that, goes on to whoever outlives the other. So it's always better for the larger benefit to be delayed as long as possible. Another key thing, claim your survivor benefit at your full retirement age or later, and, coordinate all these things, together, coordinate your and your spouse's benefits together. When we think about remarriage, remarriage at any age cancels out divorced spouse benefits unless that marriage then ends. So you could hypothetically have, a marriage that lasts for 10 years, ends in divorce, another marriage that lasts for 10 years and ends in divorce, maybe even a third marriage that lasts for 10 years and ends in divorce. All three of those could be options for you when you go to claim your Social Security. You could say, hey, you know what? My second husband, he made the most money. Let's look at what his Social Security amount would be. And, ding, 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 we've got a winner. I'm going to start to claim off of my second husband. One thing to keep in mind with that, your second husband doesn't have to have any idea. Your first, third, they don't have to have any idea that you're doing that. And say your second husband had two other ex-wives that he was married to for 10 years or more, they could do the same exact thing as well. It doesn't impact each other. It also doesn't impact the person whose actual benefit it is. Second thing, remarriage before age 60 cancels out survivor benefits and divorced spouse survivor benefits. So if somebody is widowed earlier on in life and they remarry at age 60, those survivor benefits are no longer applicable. And then the third thing, remarriage after age 60 doesn't affect any survivor benefits or divorce spouse benefits. Okay, so that concludes the informational portion of what we wanted to get through here this afternoon. We do have a couple of questions. Does the spousal benefit take away from what the spouse would get? No, the spousal benefit does not at all impact what the spouse would get. In fact, it can be a great strategy that, can just really increase the total household income. And if you have any other questions here real quick, if you want to type those into the Q&A box, we are more than happy to answer those. I'm going to throw it back over to Marcus. I know we've gone a little bit longer than we anticipated, but hope that was beneficial and informational for everyone.
Well, first, absolutely want to thank you for carrying most of that educational experience there for us, Emmett. And we did have one other question that was asked. In case somebody else may have a similar question, we do want to address that. The answer was answered live, but it was, can you claim off your ex-spouse if they are remarried? And I believe the way that question is worded is asking if your ex-spouse then got remarried. So the main thing to understand about divorce planning is that it's based on, or where Emmett had pretty much concluded the presentation was talking about if you remarried prior to the age of 60. So it depends on if you get remarried. If your ex-spouse decides to go and get married, you can still claim off of your ex-spouse as long as you meet the criteria of being married for 10 years. You reach that age requirement. So their marital status, their retirement status isn't as important as your marital status and your age of claiming. So I did just want to readdress that question there. But please, as Emmett also mentioned, please feel free to ask any other questions that you have in this moment. So as we, pretty much, I'll say conclude from the educational perspective, we are past, I'll say, a first 30-minute mark. So if you have to leave, we greatly appreciate your presence, and please be aware that we will be reaching out and following up with any feedback that you have from things that you have enjoyed from our experience this evening. Maybe there's some things that we can do better, we can go more in depth, or if there are different topics that you would like to hear in this space of retirement planning, whether it's talking about protection from market volatility, or if it's a good follow-up time for us to address any questions about Medicare as you look at 65, or if you're looking at income strategies and IRA planning. If you have any ideas or topics that you would like to hear from us, we would absolutely love that feedback. Also important is that we share this knowledge with people that absolutely need it. So we don't want these to be a secret. So if you have someone that we should be connecting with or that you believe should be participating in these experiences, we also want to be familiar with how we can reach out and connect with them as well. So please be sure to respond to any messages, whether it be email, phone call, because we're always accepting feedback, but we also want to be sure that you retain the information and that we provide some valuable perspective. If you are able to stick around, we have a little bit of a bonus round, so I'm going to be carrying more of the conversation from that perspective. I just want to show a few resources that we have. So again, if you do have to leave, that's perfectly fine. We thank you for your time. But if you're able to stick around and just bear with me for about 10 to 15 minutes, I'm going to share some valuable tidbits. So a few.
Before you pull that up, Marcus, real quick. Mm-hmm. Yeah, if you do have any questions, if you do want to reach out, obviously you've likely got our phone number, email information, all of that. You can absolutely reach out there. Another thing that you can do, you can go to our website, which is Emmett, EMMETT.ceterainvestors.com. And you can schedule a time for us to speak just by going to that website, Emmett.ceterainvestors.com, and click on schedule a call. And that will pull up my online calendar right there for you to, pick a time that would work well for us to speak as well.
Awesome. So we have a few other questions. I'll say one of the questions pretty much leads into part of the reason I'm addressing this perspective. But a few bullet points, some things that we may have missed in the presentation. first thing to understand that there is no cookie cutter recommendation for Social Security. There are a lot of things that go into determining when you should actually apply for your benefit. I know we talked about claiming early versus claiming later, but there are other things that can influence that decision, whether it be your current health or your future health, your longevity, how long of a retirement plan that you actually want to have, or how long of a retirement that you want to plan for. You may be looking at your financial needs today, right? Maybe you absolutely need that income to just make sure that you're comfortable with the rising cost of goods and services. But you also want to factor in any spouse that you may be living with or outlive. As we said before, spousal planning is a very important component of Social Security planning. Maximizing the earnings for the both is absolutely something you want to keep in mind. Second thing is understand what influences your benefit. One thing is your earnings record. As Emmett mentioned before, 35 of your highest working years are going to be used for that average. So if you have years of zero, that zero in earnings is going to bring down your average. But also, if you're somebody that's been working for 40 or 45 years, those lower earning years when you were 13, 14 years old compared to your highest earning years when you were near 65, you have to wonder what earnings are they actually using. So a lot of that can be found on your actual My Social Security website. I'll say the third thing kind of bunched in together. Fourth, be familiar with deductions from your benefits. So when you get to Medicare age, typically your Medicare premiums are deducted from Social Security. And understand that Social Security can be taxable. That's not an after-tax amount that you see on your statement. So you want to be familiar with how taxes and Medicare premiums can actually reduce your net earnings from Social Security retirement benefit check. And beware of the earnings limitation. That's not something that we really touched on at the immediate moment, but that is something that we can share following up in an email, which is a 2022 quick reference guide. So this reference guide is for this year. As you can see on the screen, it has things like your full retirement age based on that year. And fun fact, if you got the answer wrong earlier, you'll never get the answer wrong again about the reduction. So you can see based on the age, what that percentage reduction would be. So for someone, again, 67, and your full retirement age is 67, but you take it to 62, you see that reduction is about 70%. And on the high end, if your full retirement age is 66, mathematically, it's about 75. But the closer you get to that age, you clearly see either getting 100% or possibly more by delaying it one full year plus any cost of living adjustment. The earnings test, this is something that you may have heard about. If you take earnings or if you take your benefit prior to your full age at 62 or even sooner, for every $2 in excess of earnings past this annual threshold amount, they withhold $1 of your benefit. Now, that's not to say that you never get that money back. They do eventually add it back to your benefit once you reach your full retirement age. But you have to ask, if I'm planning on working and earning an income that exceeds that annual or monthly amount, for every $2 that exceeds that, they withhold $1 of my benefit. Does it really make sense to take my Social Security benefit earlier? And no, if you take it at 62, 63, 65, you don't get 100% when you get to 67 or whatever your full age is. That reduction amount is the permanent reduction amount. So a lot of these decisions behind Social Security are unchangeable. Please, again, understand it's not a cookie cutter recommendation of what you should do, but please do not make that decision alone. Allow Emmett and I to provide some perspective to look at your specific needs and provide a suitable recommendation and advice of how you should proceed for income and retirement. One of those questions that we have in our Q&A is, if you were 66 and 4 months, would it make sense for you to take your benefit and in turn then invest it? And the short answer, I'll say for my opinion, is that no. Because in terms of rate of return, as much as we love to invest, Emmett and I absolutely love the space of investing in retirement planning. We can't guarantee an 8% rate of return. We would love to guarantee it, but we can't guarantee it. Social Security indeed can guarantee an 8% rate of return. So this calculator isn't the same as the net investment one, but this is a simple break-even report. And fun fact, Miss Ida Mae Fuller was the first beneficiary of Social Security benefits. So shout out to Women's History Month Ida Mae Fuller, the first person to ever receive Social Security, was indeed a woman. And that woman lived a very long time. She actually lived to, was it 90 or 92, Emmett? Do you remember the exact age?
It was somewhere in that ballpark. I don't remember exactly.
Somewhere in that ballpark.
How old, but yeah.
But back then, living that long was not the design, right? So clearly we're living a much longer life. So this calculator, we're able to discuss how long of a retirement do you want to plan for. So in the calculator that we're able to put together, whether you're male or female, we can estimate, well, if you are planning to live a shorter than average life expectancy, an average life expectancy, or much longer, it's able to look at what your total earnings will be, but it also shows at what point in time does it make sense for you to take your Social Security. So in this example, you can see with that cost of living adjustment of 2%, and we're assuming, a $3,000 monthly full benefit, we're analyzing, does it make sense to take it at 62 as opposed to taking it at 67, if indeed this young lady experiences 84 years of living. So what you'll see is her monthly benefit starting out at 62 is roughly that, 70% decrease. So $2,102 is what she receives pre-tax for an annual benefit. Well, because she turned 62 middle of the year or beginning of the year, annual benefit that year is $16,000. And with the cost of living adjustments, you see that income gradually increases, assuming just a flat 2% increase. So much so that in her 84 years of living, in the year that she passes away, her monthly benefit is $3,266 with a cumulative earnings of $722,784. But if we compare that, right? What if she decided to take her benefit at her full age? Well, if she's still working and paying into it and their cost of living adjustments, that $3,000 per month benefit actually increases to $3,312. So much so that by the time she reaches 84, compare and contrast, her monthly benefit is then $4,638 for a total cumulative earnings of $840,000. So most people from our experience, when they look at their Social Security, they're only looking at this monthly difference. It's still roughly about $1,000 a month difference. But what is the end result? If you're planning to, live for 80, 84, 85 years, is that really just an $1,000 per month difference? Or is that nearly $120,000 difference in your total earnings in retirement? That's more of the focus or perspective that we're encouraging you to look at as you're considering taking Social Security. And this also can be analyzed for if it makes sense for her to wait till 70. So being that we're expecting her to live to 84, you still see that the longer she allows that benefit to grow, her first month benefit at 70 is indeed $4,359. And her now total cumulative earnings is $890,000 compared to what it would have been at 67. So that's just some high level perspective of how this resource can be used and analyzed for if it makes sense for you to take it early or for you to take it at 65, 67, whatever that age mark is. If you're someone who's married and you want to say, well, let's look at this not just from my individual perspective, let's look at this from a spousal planning perspective as well. So we also have spousal planning analysis that we can run. And in this case, we're looking at two earnings records. So whether it makes sense for both individuals to take it at 62 versus taking it at 65 or 67, if it makes sense for both to claim at their full retirement age, right? So there is no extra delay. If it makes sense for one person to claim now, the other person to claim their benefit later. It all depends, again, on how long of a retirement are we expecting to live. And what you can see in total, I'll say nominal benefit from each of these options, they all have a significant difference. So the longer life that you're expecting to live in retirement, clearly the better benefit is to wait. But if you're someone that doesn't believe that you will experience a long life in retirement, it is okay to either claim early or claim at your full age. Again, keep in mind those factors that lead into that determination. And finally, if you're someone who has been divorced or if you're currently unmarried, we also have divorce planning reports. So the divorce planning report is just assuming that this young lady was indeed not the breadwinner. She may have spent some time at home. and her husband's primary insurance amount was greater than 2 times hers. So her primary insurance amount, $1,200 per month at her full age, where her ex-spouse primary insurance amount was actually $3,000. And it provides you two different scenarios, again, based on what your expected mortality is, what the average cost of living adjustment is, what makes sense between claiming early versus your maximum lifetime nominal benefit. So I'm not going to get too inundated on the numbers, but I want you to be familiar with some of the resources we have as we continue to provide education and perspective on what you should do in your individual plan. So I'll leave that with any questions that you have. I appreciate it if you, I do appreciate you sticking around and joining us in this different perspective of Social Security.